Warren Buffett, even before he became a household name, wasn't born into the world as the legendary, patient investor we know and admire today. His journey began far from the boardrooms and billion-dollar deals. As a bright and curious boy growing up in Omaha, Nebraska, he was utterly mesmerized by the seemingly chaotic dance of the stock market. The flashing numbers, the endless stream of ticker tapes spilling out of the machines, it all held a powerful allure for young Warren. He'd eagerly spend hours at the local brokerage, a place buzzing with energy and the constant hum of financial activity. He was captivated, watching the stock prices scroll by on the ticker tape, convinced that he could decipher the market's secret code, that he could predict its every move. Buffett diligently filled countless notebooks with meticulously hand-drawn charts, each line and curve representing the fluctuating fortunes of different companies. He was tirelessly searching for patterns and hidden rhythms in the seemingly random movements of stock prices, believing that the key to unlocking wealth lay in predicting the short-term fluctuations. He firmly believed that the secret to accumulating wealth was in outsmarting the market and, more importantly, outsmarting other investors. His focus was laser-locked on predicting tomorrow's stock prices, trying to anticipate the next big swing. For him, investing felt like a thrilling game, a high-stakes contest of quick wits, rapid calculations, and lightning-fast moves. It was all about being faster and smarter than the rest. He was completely hooked on the adrenaline rush, the excitement of the chase, rather than the underlying substance and value of the companies he was trading. The idea of actually owning a piece of a real tangible business, with its slow and steady growth, seemed incredibly boring and abstract to him. Instead of seeing stocks as ownership in companies, he treated them more like lottery tickets, placing his bets on short-term momentum, fleeting trends, and unpredictable price swings. He hadn't yet grasped the fundamental principle that the price of a stock is often the least important number to consider when making an investment decision. What he was doing wasn't true investing in its purest form, it was, in reality, gambling, cleverly disguised as a sophisticated investment strategy. Sadly, most people never manage to move past this initial stage of speculation and short-term thinking. They continue to see stocks merely as abstract symbols on a screen, rather than as representations of real operating businesses with intrinsic value. Warren Buffett's remarkable journey to becoming the world's greatest investor began in this noisy, chaotic world of speculation and short-term trading, but it wouldn't be long before a particularly painful and costly mistake forced him to completely rethink his approach to the market and reevaluate everything he thought he knew about investing. The crucial lesson that ultimately changed his life and set him on the path to true investing wasn't born from a triumphant win or a stroke of good luck, but rather from a humbling and costly error that shook him to his core. This pivotal moment marked the first crucial step on his long and transformative path from being a mere speculator to becoming a true, value-oriented investor. And it all started with a bright, ambitious young boy chasing the elusive signals hidden within those endless streams of ticker tapes. Even at a young age, Warren Buffett possessed an entrepreneurial spirit, always looking for opportunities to grow his small fortune. At 11, he took a significant step, venturing into the world of investing for the very first time. 3 shares of Citi's service preferred for himself, a purchase that would become a pivotal learning experience, shaping his investment philosophy for decades to come. And showing his inherent sense of responsibility, he bought 3 for his sister Doris too. He wanted her to share in the potential rewards of the stock market. He bought in at $38 a share, a price he likely considered carefully, weighing the potential risks and rewards. But almost immediately, he was confronted with the unpredictable nature of the market, only to watch the price drop to $27. The loss stung, a harsh introduction to the volatile world of finance and the emotional roller coaster it can induce. It was especially difficult with his sister's money on the line, adding an extra layer of pressure and responsibility to his young shoulders. He anxiously watched the daily price, glued to the financial pages, hoping against hope for a turnaround. He was constantly checking, charting, and reevaluating, hoping for a rebound, a sign that his investment wasn't a complete failure. Eventually, after what must have felt like an eternity to an 11-year-old, the stock climbed back to $40. Relieved that he hadn't lost money and with a small profit in hand, he sold everything. It felt like a victory, a successful navigation of the treacherous stock market waters. But the story didn't end there. He kept watching, a habit that would ultimately reveal a crucial lesson. Citi's service didn't just recover, it began a period of substantial growth. In fact, it soared past $200 in the years that followed, a staggering increase that highlighted the power of long-term investing. That tiny gain he'd been so proud of now looked like a massive missed opportunity, a painful reminder of what could have been. The real mistake wasn't buying the wrong stock. Citi's service was ultimately a sound investment. It was selling too soon, driven by impatience and a lack of long-term vision. Buffett realized he'd been thinking in days and weeks, reacting to short-term fluctuations. He hadn't considered the potential for growth over years, the true time frame for building wealth. He let short-term noise dictate his actions, allowing the daily ups and downs of the market to cloud his judgment. In doing so, he was missing out on the real rewards of patience, the power of compounding, and the potential for exponential growth. The lesson was clear: patience is not just a virtue, but a critical component of successful investing. The market's quick moves are a distraction, a siren song that lures investors into making rash decisions. True wealth comes from holding on to great businesses, allowing them to grow and compound over time. It's not about flipping stocks for a quick buck, chasing fleeting gains, and trying to time the market. He treated stocks like lottery tickets, hoping for a quick win rather than understanding the underlying value of the companies he was investing in. He was cashing out at the first sign of profit, prioritizing immediate gratification over long-term growth. This experience burned a new rule into his mind, a principle that would guide his investment decisions for the rest of his life. Don't let impatience rob you of compounding. The longer you hold on to a good investment, the more it will grow. The real money is made by staying put, by having the conviction to hold on to your investments through thick and thin. Buffett knew he needed a new approach, a more disciplined and patient strategy that focused on long-term value. He was ready to stop playing the market's game, stop trying to predict short-term movements and outsmart the system. He wanted to stop thinking like a trader and start thinking like an owner, focusing on the underlying businesses he was investing in. That shift in perspective, from short-term speculation to long-term ownership, would change everything, setting him on the path to becoming one of the greatest investors of all time. Warren Buffett's journey took a pivotal turn when he arrived at Columbia University. It was here, amidst the hallowed halls of academia, that he encountered something that would forever alter his perspective on investing and business. His turning point came in the pages of Benjamin Graham's seminal work, The Intelligent Investor. This wasn't just another book, it was a revelation, a comprehensive guide that demystified the world of finance and offered a rational, disciplined approach to investing. Graham's message was simple but radical, a stark contrast to the speculative frenzy that often gripped Wall Street. He emphasized that a stock is not merely a piece of paper to be traded, but rather a tangible ownership stake in a real operating business. It's not just a ticker symbol flashing across a screen, subject to the whims of the market. When you buy a share, you're buying a piece of something substantial. You're buying a piece of factories, brands, the dedicated people behind them, the entire enterprise. It's not just a line fluctuating on a chart, driven by fleeting emotions and short-term speculation. This profound idea cut through the market's daily noise, the constant barrage of information and opinions that often cloud investors' judgment. Graham taught Buffett to focus intently on what a business is truly worth, its intrinsic value, based on its assets, earnings, and future prospects. Not what the market, in its often irrational exuberance or despair, says it's worth today. The ultimate goal is to buy good, fundamentally sound businesses for significantly less than their intrinsic value, creating a crucial margin of safety. This simple yet powerful concept was the very foundation of value investing, the cornerstone of Buffett's future success. It fundamentally transformed Buffett from a speculator, chasing quick profits, into a true business owner, focused on long-term value creation. The painful lesson learned from selling Citi's service too soon, missing out on substantial gains, became a crucial lesson in the importance of thinking long-term, of having the patience to allow good businesses to compound their value over time. Graham's profound wisdom provided Buffett with the logical framework and the disciplined approach he'd been searching for, the missing pieces of his investment puzzle. He learned that the market exists to serve you, the investor, not to dictate your investment decisions or instruct you on what to do. This single powerful insight would shape Buffett's entire career trajectory and ultimately generate billions of dollars in wealth. Sometimes all it takes is the right book, read at the right time to change everything. Many think investing is a game for geniuses, but Buffett's story proves otherwise. His success wasn't about IQ, it was about temperament. The real challenge is staying rational when the market goes wild. Graham's teachings gave Buffett a framework for sanity in a world of emotional swings. The market is a pendulum, swinging between greed and fear. Even brilliant people get swept up in the mania, making costly mistakes. Buffett's edge was emotional discipline, sticking to his analysis, ignoring the crowd. He famously sat out the dot-com bubble, refusing to invest in businesses he didn't understand. He looked foolish until the bubble burst. Investing rewards patience, humility, and self-control, not raw intelligence. Can you hold a stock for 10 years, even if the market closes? That's the real test. Buffett's story is proof. A stable mindset beats a volatile genius. In investing, sanity is your greatest asset. Imagine buying a farm. You study its soil, crops, and earning power, then buy it for the long haul. You don't obsess over daily price quotes or your neighbor's wild offers. You focus on the farm's output, its real value. The stock market is like that noisy neighbor shouting prices every day. Most people listen. Buffett learned to ignore him. He buys businesses for their long-term cash flow, not for quick trades. Investing is about ownership, not speculation. Would you sell your apartment building just because prices dipped this week? Of course not. True investors anchor decisions in reality, not market mood swings. This mindset lets you sleep well no matter what the market does. Think like a farmer. Own the business, not just the ticker. Buffett's greatest lesson isn't just about money, it's about building a life you love. He structured Berkshire Hathaway around trust and autonomy, letting great managers run great businesses. The goal isn't just profit, but creating a place where people do their best work. Who you invest with matters as much as what you invest in. Partnering with honest, capable people brings peace of mind and better results. True wealth is more than a bank balance, it's a life rich in purpose and trust. Buffett's joy comes from meaningful work with people he admires. Money is a tool to build a fulfilling life, not an end in itself. If chasing returns makes you miserable, you've paid too high a price. Seek alignment between your investments and your values. That's the compounding that matters most. Imagine the market closes for 10 years. What would you buy? Suddenly, short-term noise disappears. You'd focus only on businesses with lasting strength and honest management. You'd ask, will this company thrive a decade from now? This mindset forces you to think like a true owner, not a trader. Buffett's favorite holding period is forever. Acting as if the market is closed frees you from daily distractions. It sharpens your focus on what really matters, durable value and steady growth. If you wouldn't hold a stock for 10 years, you probably shouldn't own it at all. That's the Buffett way. Buffett is a relentless optimist about America's future. For 2 centuries, betting against the US has been a losing game. The American tailwind, innovation, rule of law, and entrepreneurship, drives long-term prosperity. Through wars, depressions, and crises, the country has always bounced back stronger. The system rewards new ideas and hard work, lifting all boats over time. Buffett's own life is proof. He's invested through every kind of turmoil, and American business has kept growing. A simple S&P 500 investment decades ago would have turned modest savings into a fortune. The lesson? Don't get distracted by scary headlines. Trust in the long-term productive power of the country. The American tailwind is the most powerful force in finance. Let it work for you. After a lifetime of investing, Buffett's advice for most people is simple. Don't try to pick stocks or time the market. Buy a low-cost S&P 500 index fund and keep buying, no matter what. This strategy gives you a stake in America's biggest, best companies. You don't need to analyze or predict, just own a piece of everything. The key is discipline. Invest regularly, reinvest dividends, and leave it alone. Compounding will do the rest. It's not a get-rich-quick scheme, but a get-rich-surely plan. Even for his own family, Buffett recommends this approach. The secret isn't to play the market's game, it's to let compounding work for you. That's the final lesson from the boy who once chased ticker tapes.